Hello, hello. This is Peter Nelson with Nelson Insurance Advisors, and we have here once again the man, the myth, the legend, Logan Hertz from Hazeltine LLC. Logan, how you doing?
Hello, Peter. I'm traveling, so I'm actually in a hotel, but I'm making the time to speak with you because this is really important.
Well, great. Well, thank you for making this time. And you know what? Let's not beat around the bush here. Let's get right into it because I believe we're on what, part 6 of the financial malpractice?
Part 6. So again, we have this 75-year-old who's financial advisor, who is a supposed fiduciary, well, is a fiduciary, has manipulated him into keeping all of his money in the market forever. It really is that simple, folks. It really is that simple. I want you to be able to cut through all of the, rhetoric and, fancy supposed models, which are really just marketing. And when someone wears on their sleeve and advertises that they are a fiduciary, what they're really saying is, I'm bought and paid for by Wall Street. That's really what they're saying. People who act in their client's best interest don't need to advertise the fact. The proof is in the pudding. You can see it, right? So I did want to revisit just a couple of things that came from our last call. First of all, I found it interesting. Okay, this is actually really interesting the more I think about it. He's telling him, the client, the financial advisor is telling the client, well, we have this really cool like estate strategy. It's called a step up in basis, right? What that means is, Peter, if you have taxable gains in your investment account, okay, but you leave the money there and you don't withdraw it, then when it goes to your heirs, those gains aren't taxed. I was like, that's interesting. A step up in basis. Well, what we could also do? We could take $50,000 and buy a $700,000 death benefit permanent life insurance policy, and that would all be tax free. So we just got a $650,000 gain with no taxes. Okay. So if you really want to do something like that, why don't you just use the vehicle that's structured exactly for that? It's called whole life insurance, right? This step up in basis, you can get it with no market risk, and you can get all those quote unquote gains tax free. How about that? But it gets even more interesting, because you know what this is, Peter? When I say it boils down to keep your market in the money forever, this is exactly what he's doing. He's saying, not only are you going to keep the money locked up in the market while you're alive, you're going to keep it locked up in the market after you're dead. And I'm going to continue to benefit from it as your financial advisor, because I'm holding out this carrot. I'm holding out, really, it's more of a stick than a carrot. If you withdraw anything, you're going to pay taxes on it. You don't want that, do you? So leave it there, right? And until you die. And then you won't have to pay taxes on it, right? And then now I have your children as clients. So now I'm going to tell them why they should keep their money in the market, so it'll keep earning for you, right? So I can keep all your money in the market, quote unquote, the market, right? Mutual funds forever, right? Because of these phantom benefits I'm advertising, which we could get much more easily with whole life insurance. But instead, we're going to do it this way.
Yeah. Not, you mentioned with the stick. Sounds like this advisor wants to beat the client with the stick,
It's really sad. It's really sad. These are the tactics that they use, folk. Again, it's the 4 rules of financial institutions. Just think about the relationships you have with various financial institutions that you have, and ask yourself how many of these rules apply. Number 1, give us your money. Number 2, give it to us on an ongoing, systematic basis. Number 3, let us keep it for as long as possible. And number 4, if and when we give it back to you, we're going to give it back to you as slowly as possible, right? In this case, the client has given him all of his investable assets, right? He's probably, in the past, I'm sure he was giving it to him on a systematic basis. He may still be today. I don't know. They've kept it forever, right? And they're never going to give it back to you. And your children aren't going to see it either, right? So yeah, that's really what it boils down to. Whereas with whole life insurance, you have liquidity from day one. You can take out a policy loan day one, and your money keeps earning for you. The liquidity is phenomenal, right? Liquidity, access, and control. That's what you have with whole life insurance. Liquidity, access, and control. Okay. All right. And then the other thing is just this thing that he repeated more than once, which is perhaps the most asinine thing I've ever heard said about life insurance. And that's really saying something, by the way. The idea that when you take out a life insurance policy, you're making an actuarial bet that you're going to die sooner than expected. If this were true, life insurance would always be a losing proposition. Always. Because guess what? You're going up against the experts. The actuaries at the life insurance companies, they are experts at predicting your mortality, and they are always going to win that bet. Always, every single time, all day, every day. It's what they do for a living. So if what this guy was saying was actually true, then life insurance is always a losing proposition, and nobody should ever buy life insurance because it's win-lose, right? The life insurance company wins and you lose, right?
Right. I mean, you've probably heard me talk about that time the guy was paying now this was a term policy, but $50 a month term policy ended up paying out $1.2 million. You know, was that a losing proposition for that family? Now, did someone have to die too at the same time? Was that a good deal for the family? No, but that was pretty amazing, wasn't it?
Well, and again, it's like saying, Peter, when you take out a homeowner's insurance policy, you're making an actuarial bet that your home is going to burn down.
Right.
And if your home burns down, you win and the insurance company loses because you collected that, the insurance money. Whereas if your home doesn't burn down, the insurance company wins and they got your money. Ha 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 ha. Right? It's like, no, that's not the way any insurance policy works. Okay. Whether your home burns down or it doesn't, your homeowner's insurance policy did its job. Okay. Whether you die sooner than expected, when expected, or later than expected, your whole life insurance policy did its job. And by the way, Mr. Financial Advisor, you have this illustration in front of you. Okay. Look at the illustration and tell me, where in that policy are you ever going to have a death benefit that's less than what you paid in? The answer is never. It's guaranteed. It's actuarial math. The rules of math are not flexible. It's guaranteed. In this particular policy, you look at the illustration, and the death benefit is always more than what you paid in, substantially more, right? So that's just an utterly ridiculous, completely asinine thing to say. And I think it's a little bit important to revisit that so people can understand how, these guys who have all these credentials, can make the most elementary. I mean, there's not this proposition is nothing short of idiotic, folks. Okay, got to understand. It's not just bad, it's asinine, right?
But it's, I mean, once again, whether he knows what he's doing or he was just trained that way. I was trained this way in February of 2002, folks. So this is normal financial planning. This is the way we're taught. I was 21 years old when I was taught exactly these things Logan is talking about that might be considered asinine, but that's the way we're taught. Okay.
Well, and he couches it all in this lecturing, condescending, speech, lecture, basically, which is just so insulting to the client. Treating the client like, you don't know what you're doing, but I'm the expert, so you should listen to me, and I'm going to use big words. Meanwhile, saying things that are totally asinine. Basically, what it is, it's psychological manipulation. Another word would be bullying. This is bullying, is what this is, right? I don't bully my clients. I educate them, right? And I let them make their decisions. If they're not the one in charge, we have a problem, right? The client needs to be the one in charge of decision making. And I can never get away with lecturing my clients this way, right? It's so disrespectful to the client. My clients are very intelligent people, okay? And they would not put up with this kind of bullying. They would not give up. They would not accept this. They would, at the very least, be, oh, is that true? So you're telling me that if I put my money into a life insurance policy, the insurance company wins and I lose? Can you demonstrate that, please? Like, oh, there's a break-even point. He made up this term, a break-even point. This is an accepted term in the policy. Oh, could you show me that, please? Here's the illustration. Show me where in the illustration I break even, meaning the death benefit is now less than what I paid into. Please show me where that is. Right. It can't happen. It's never there. You're always coming out ahead. Okay. So yeah.
I'm pretty sure in that Ernst & Young report, I never saw a point where Ernst & Young said there was a break-even point. I mean,
right.
No.
They didn't say you're making an actuarial bet. He has to throw in the word actuarial to say, see, I'm using big words. That means I'm smart, right?
And they're, by the way, they're one of the top 10 largest accounting firms, and they didn't even use that wording. I mean, that's it's pretty astonishing.
Yeah, again, it's very simple. Give us all your money and let us keep it forever. And by the way, it's all at risk. It's as simple as that. Could not get any simpler. Okay. All right. So let's move on a little bit to what he said. And again, I'm sorry, this is going to be difficult for me to get through because, well, what he's saying is just so ignorant, to say the least. Okay. All right. You don't need to overcomplicate liquidity. We've already read this, but I'm going to say it again. You don't need to overcomplicate liquidity by paying premiums into a whole life policy to serve as your own banker. Over the first 5 years, you would need to pay $250,000 into the policy only to have access to a cash value of $215,000. Okay, again, cash on cash return. Okay, that's not what we're talking about here. What's really going on is $250,000 that you were going to spend that would have permanently left your personal economy if you had used the standard banking system. Okay, of that 250,000, you now recovered 215,000. That sounds like a great deal to me, right? It's not, oh, I invested 250,000 and I only got 215 back. No, it's by running your cash flow through this much more efficient vehicle, you recovered a pretty large percentage of that money that would have permanently left your personal economy. And again, to say you have 215,000 is not accurate. This policy started with, I believe, a $700,000 death benefit. That's what you actually have, right? That's what you actually have. And that death benefit grows. So whatever it is, year 5, it's more than that, right? So if you die, when you die, a death benefit of more than 700,000 will pay out. So you paid in 250,000 and you got more than 700,000 out of it, tax-free. Call it a step up in basis if you want. We don't have to use these idiotic terms because it's very simple. You're purchasing a death benefit,
And
right?
as we've talked about before, what you're really talking about giving the person is you're giving them a permission slip to spend the majority of their money while they're alive. And then the minute they die, the death benefit will actually replenish all the money that they used while they're alive, so that the people that took care of them could be taken care of as well, right? That's really what you're saying in a nutshell.
Right, like this, this financial advisor is demonstrating. People who invest their assets in the standard way, they're always afraid to spend them. They're always afraid to draw down their account, right? Because when they draw down the account balance goes down. When you have a permanent death benefit, you don't have to worry about legacy. We've taken care of legacy. Okay, in his earlier email, he's basically said we don't care about the kids, right? Because we failed. Our financial plan has failed so miserably. We can't worry about the children. We're just worried about you trying to survive through retirement. We're not worried about the children because we can't leave anything for them, right? Yeah. Whereas if you had a permanent death benefit, you've taken care of that problem. You now know exactly what you're going to leave to the children. You can spend that death benefit, at least a portion of it, while you're alive, and the cash value and the death benefit keep going up while you're using it, right? So unlike money in the market, where when we withdraw it, our balance goes down and we're no longer earning on it, here, thanks to the policy loan feature, we can access that money without taking on debt. Meanwhile, the whole cash value balance and the death benefit keeps earning for us, right?
Absolutely.
Okay, here we go. And then if you need to access cash, you need to get a loan from the policy and accrue interest. I would much rather keep that sum invested and peel back portions of the portfolio to generate cash flow. I'd be interested to see what your strategy is for that. Can you please demonstrate how that will work? How are you going to peel cash from the investment portfolio and generate cash flow from it? Please explain this to me. I mean, it's just ridiculous. It's ridiculous. Okay. Because of course, he's talking out of both sides of his mouth, because really what he's going to tell the client is, no, don't touch any of it. Don't take any money out of it. That's what he's telling the client. But then here he's saying, oh, we can peel cash from it and create cash flow. Really? How are you going to do that with a mutual fund? I'm not familiar with this strategy. Please explain it to me.
Well, not even to mention what happens if your client wants money and the market just went down 20, 30, 40, 50%, right? How's that going to work?
Mm-hmm. Mm-hmm. And what if he has a long-term care problem?
Yeah.
How's he going to fund that? What if he dies? What happens to his wife? What happens to the children? What happens to the grandchildren? Oh yeah, we don't. In an ideal scenario, maybe we'd have something for him, but our financial plan really doesn't take any of that into account, because it's just give me as much money as possible, and I'll take care of everything. Don't worry.
Now, I know we've talked about this over the episodes, but I think it's good to just come back to this real quick. How much did he have total in assets again, roughly?
Yeah, I don't want to mention specific numbers, but certainly it was not enough to comfortably retire. He's certainly nervous about retirement.
Right? I guess my question is, you don't even have to say it, but you weren't necessarily saying to move all the money away from the investment advisor at one time, Were you, or were you?
No, we didn't even get to that point because my first question, when I looked at his assets, I'm like, okay, so you have all your money in two places: your paid off house and a brokerage account. That's basically it. There is some others, but that's basically the vast majority of it, right? And your paid off house is more than all the money you have in the brokerage account. So immediately I'm thinking reverse mortgage, right? His financial advisor never brought that up to him. How can you not talk about that? Long-term care, the client definitely expressed a concern about long-term care. That clearly has not been addressed. And so my question back to the client was, oh, you're 75 years old. You have all your money at risk in the market. I assume there's some plan to draw that down, right? I mean, something like roll it over into an annuity or something. And so that was kind of the open question that I was expecting his financial advisor to answer. And of course, the answer we got is there's no plan to withdraw anything. Why would we do that? So yeah. So really, it's a question to the client. Again, I'm letting my client make the decision. I'm not telling him how much of that to draw down and how and when to draw it down. If his financial advisor were acting in his best interest and were willing to partner with me the way that other financial advisors have, we could work together and we could come up with a plan, and we put the client in a much better situation. We could roll some of that portfolio into an annuity that would then give you guaranteed income that you could fund the whole life policy with. Take out a reverse mortgage. Now you freed up a lot of liquidity, have some form of long-term care plan in place, whether that's part of the whole life policy or separate, right? All of a sudden, we've taken care of so many problems. We've got you income. We've de-risked you. We've got a permanent death benefit in place. We got long-term care protection in place. We freed up a lot of liquidity, right? And I was talking with you off camera about this, Peter. This coordination among financial professionals is so important. And when financial advisors act the way that this one does, where he's just viewing everybody else as competition and behaving, as Chris Kirkpatrick would say, like Gollum, mine, no, you're not going to get any of it, right? Instead of recognizing that we're all here to add value to the client and we all actually help each other grow. So as an example, I have a client currently, I referred him to an estate planning attorney because unlike this financial advisor, I'm not pretending to be an expert in estate planning, right? And the estate planning attorney had some ideas and we discussed it, me and the estate planning attorney. And he was so thankful to me. He expressed to me his gratitude when I educated him on a few things that he didn't understand about life insurance. And as a result, we're going to come up with a much better comprehensive plan because we're working together, right? We're coordinating. So many people, they have their CPA, they have their financial advisor, right? They have their life insurance agent, they have their property and casualty agent. And none of these guys ever talk to each other and none of them ever coordinate. Right? If we could just coordinate a little bit instead of the financial advisor fighting everyone tooth and nail because he views them as competition, the financial advisor will make a lot more money, first of all, right? Because you free up that liquidity from the reverse mortgage as an example. Guess what? Now he has more money to put in the market if he wants to, or if he has some kind of a crisis, he's not going to have to draw down assets in the market because he has the reverse mortgage line of credit that he can draw on. So every way you look at it, the financial advisor would have benefited a lot more and the client would have benefited a lot more if he had taken the opportunity to partner with me, which was the way I was viewing it. I was opening my arms to him, say, hey, let's partner, let's come up with a solution. And instead, he's behaving like Gollum and he's dragging his client down with him, unfortunately.
Yeah, absolutely. It's I think I've heard Tom Hegna over the years say that advisors are afraid to commit. And now this isn't talking about annuities, but afraid to commit a annuicide, right? They think that if by putting some money into an annuity, that's actually gonna kill their revenue, right? In a way, their AUM. But at the same time, what they've found, it actually does the opposite. It actually makes them more money because the clients are happier, they refer more people, and they don't go looking elsewhere. So they're actually more loyal. Right?
Yeah, the first thing I do when I get a client in is I improve his financial situation any way that I can and give him immediate concrete results. And the intangible benefits I get from that are far better than any tangible benefits. I'm probably not making any money off of the recommendations I'm giving, which are immediately giving that client another $300 a month of cash flow by optimizing your housing payment, by optimizing your property and casualty insurance, by moving you away from health insurance to health sharing, right? By optimizing your bank accounts and credit cards, okay? But the intangible benefit I get from now I've established credibility with that client, because I'm not saying, well, give me your money and then you won't know if the plan actually works until 7 years of hindsight and we can see how the market performed, right? which by the way, I'm not doing anything. It's the market doing the work, right? Instead, I've given you immediate, concrete, tangible results, which other people don't do. So as a result, you're going to engage with me, right? I've established that level of credibility, and you're going to give me referrals because I've done something for you that nobody else has. And when it comes to build your infinite banking system, you're going to have more cash flow available, right? So we can take out larger policies because I just freed up a bunch of cash flow. Like if this particular client would take out a reverse mortgage. In fact, I'm working with a client right now. We're working on a reverse mortgage, right? With Don Graves, and that's going to free up a lot of liquidity. And so this client, I've already established a lot of credibility with him because I've solved a major problem for him already.
Right.
So, okay, moving on. Boy, this is tough to get through. Okay, we can continue harvesting capital losses all the while to offset any gains on distribution. Now, this is the first time he's brought up losses. Interesting.
I'm about ready to say that's an awkward conversation.
Yeah, what happened to the 10% returns that you were promising or whatever? All of a sudden, we're talking about losses. That's interesting. So we are going to have losses, apparently. You're 75 years old, and now all of a sudden capital losses are a benefit because
Remember,
I guess you can offset the taxes that are due.
remember, it's not a retreat, Logan. It's a strategic withdrawal.
Oh, boy. Okay. Okay. All right. Further, any loan balance at your joint deaths is repaid through the death benefit. Okay, that's interesting. I don't know what death benefit he's referring to. Maybe there is a life insurance policy in force. Okay, that could be
All
interesting.
right, say it again.
Well, he said, further, any loan balance at your joint deaths
No,
is
he's
repaid.
talking about the life. He's talking about the cash value life insurance.
Yeah, okay, yeah. Further, any loan balance at your joint deaths is repaid through the death benefit. Since you'll depend on this for future cash flow, it further reduces any IRR on the policy. Okay, first of all, we're not depending on it for cash flow. Okay, that's not what we're doing. Once again, he doesn't understand the infinite banking concept. We're using it as our cash flow management tool, the same way you use a checking account today. Now, it will generate passive income, okay, for sure, but we're not depending on it for cash flow. Okay. And then he says any outstanding policy loans will reduce the IRR on the policy. Okay, well, the IRR is going to be ridiculously good on that death benefit. No matter how much you take out in cash and policy loans, your IRR is going to be ridiculously good relative to what you would get in the market. Okay, so I don't know what it would be. And again, the question as always is as compared to what? That was money you were going to spend anyway. If you use a policy loan to spend it, you're going to spend it, whether you take it out of cash, whether you take it out of the investment account, whether you use a policy loan. That money was going to be spent anyway. The difference here is you recover that money because of the death benefit.
Yep. He lost me when he said IRR. Just it's like it's not an investment. Stop.
Yeah.
Stop comparing it to an investment. It's not a darn investment.
Of course.
I curse any advisor that says that, and any life insurance agent that tries to make it an investment. Cash value life is not an investment. Never has been, never will be.
It's never the logic of people like this. It's always their premises. They're making all these assumptions without even stating them. We're depending on it for cash flow. No, we're not. I never said that. You don't understand the infinite banking concept. You don't understand how we're using this. The IRR will be reduced. Why is IRR a relevant metric? This is not a mutual fund. This is not an investment account, okay? It's about recovering all the money you're going to spend. This client is 75 years old. He will be spending money from now until the day he and his wife both eventually die. The infinite banking concept allows us to recover that money that would have permanently left your personal economy. So whatever IRR you're getting on the policy, let's say it's, I don't know, let's say it's something low, like 5%. What's happening is not what the advisor is thinking. The advisor thinks a 5% IRR on whole life means we took money, we parked it in whole life, and we only earned 5%. That's not what happened. What actually happened was we took money we were going to spend anyway. We flowed those expenses through our whole life policy. And now we've recovered all of that money plus an additional 5%. That's what's actually happening. And that is a phenomenal deal because, again, you're going to be spending that money anyway. This is money you're going to be spending anyway. So as long as you're going to spend it in the most efficient manner possible, which is using your own private bank to issue policy loans to finance those purchases. So now your private bank gets paid back plus interest. Sound like a good deal to you? It sure does to me. And by the way, the death benefit, the IRR and that death benefit, pretty darn good. You pay in a $50,000 premium, you immediately have a permanent $700,000 death benefit, and that death benefit grows with every single premium payment you make.
Yeah,
Pretty sure the IRR on that is pretty darn good.
and here's the other part that we actually, and I've mentioned this before, that we can't factor into this. If you got, Logan, you have this client that has a whole pile of money in cash value life insurance, and the market crashes. When's the best time to buy into the market? When it's higher, when it's low? When it's low, right? And can we access the money out of that policy to take advantage of it? But can we even correlate? We don't know what that IRR is going to be, right? So I don't want to compare this to an investment, but at the same time, if you want to go down that path, I got news for you. With what we're looking at in the economy right now, and we're getting close to the 100-year anniversary of the Great Depression, I would argue that I could actually make the IRR in a cash value life insurance policy actually make more money if you factor in accessing the cash when you need it the most to take advantage of every single government, Wall Street, and bank screw up for the rest of your life. You can't factor that into this, to the IRR. You can't do it until it happens later on, right?
Yeah. And once again, in the life insurance illustration, we are making the most conservative investments imaginable. Whereas in his, whatever he's promising the client, he's making ridiculously absurd assumptions like you'll get 10% returns. Well, we all know that's not going to happen, right? There are going to be down years. As he mentions, capital losses, okay?
Capital losses.
So clearly we've had some down years. We all know the market is not going to go up 10% every year. We all know that's not the case. Yet somehow he's allowed to compare that ridiculous assumption with a life insurance illustration where we're illustrating the lowest dividend that this particular company has ever paid in its entire history for over 170 years for the whole life of the contract. So I think what we're illustrating is the absolute worst case scenario, and we have a guaranteed rate of return. We can never have a down year, and you have that leveraged death benefit, right? So in the market, the problem is time doesn't work in your favor, really, if you're 75 years old. Time is now working against you, right? You don't have time to wait for those returns to materialize. With whole life, time does work in your favor because you immediately have this permanent death benefit. And I'm not suggesting it would be a good thing if the client dies, but if we're looking at IRR, the way this advisor is myopically focused on it, well, the sooner he dies, the better that IRR on the death benefit is going to be, actually. So from an IRR perspective, the IRR on the death benefit will crush anything in the market, and it is 100% tax-free, right? If you're using life insurance, you don't need this stupid estate strategy. You've got it in whole life insurance, right? And when he talks about previously about, joint titles and all that, and I don't know how this fits in. Yeah, you don't know because you're ignorant of how whole life works. It's very easy to handle all estate planning, well, not all estate planning needs, but to meet your estate planning goals within whole life insurance. That's what it's built for. Where's your trust, right? You can have a trust be the beneficiary of the policy. You can have a trust be the owner of the policy. It's not challenging at all. But the client, again, the financial advisor, I guess, is assuming that because it's a survivorship policy, that means it's joint ownership and that causes problems. No, not at all. We can easily address that. No problem.
Yeah. You know, it's stunning to me. It just hit me. It's stunning to me. Guys like this, you know, if they just incorporated some cash value life insurance into their, into what they're doing, could you imagine how much more money they would make? Oh my gosh.
Yeah.
And the clients would love them for it.
Right. And while de-risking, right? Like you keep mentioning, Peter, this is what the client told me because I talked to the client and I'm like, when I was explaining to him, you can put this into a survivorship annuity where there's no risk, right? And you guaranteed return of principal, you and your wife cannot outlive it. You're going to get paid an 8.5% interest rate. It's a guaranteed 8.5%. He was like, yeah, but my financial advisor is telling me I'll get more in the market. And as I mentioned, that's totally irresponsible for him to promise you that. But secondly, I was like, okay, but that's not guaranteed. And the client came back with a programmed response. Yeah, higher risk, higher reward. You know, if I want a higher return, I got to take on more risk. 75? Really? Like, I don't think that's ever the case, right? I agree with you, Peter. If anything, it's the opposite. What does Warren Buffett said? Does Warren Buffett say, I got more rewards because I took on more risk? No, he says exactly the opposite. He says, rule one of investing, never lose money.
Right.
Rule 2, never forget rule 1, right? And oh, by the way, the problem too is if you're really going to do that, okay, you need to be taking profits along the way. Any good investor knows this. If your portfolio is up, you need to start selling. You need to take profits. You need to take some money off the table periodically, systematically.
Well,
But
he
Wall
is.
Street won't
He's
ever
taking.
let you do that. Well,
He
they
is.
won't let you do that.
He is though, Logan. He's taking losses off the table.
See, but I think that's all just phantom. That's just
I
the
know.
financial advisor saying we
I
could, in
know.
theory, do that, trying to pretend like he has some alternate strategy when really it's just no, let me keep all your money forever,
Yeah.
right? You know, that's what it boils down to, right? Again, oh, you're going to peel off some money to create cash flow. Can I see that strategy, please? I would like to see that laid out, please.
Yeah.
Right.
Well, let's go into one more interesting tidbit, and then we'll wrap up, and we'll go to, I think, part 7 here.
Okay. Oh boy. On top of this, I don't even know how you continue to fund the policy if you live long enough. If you put 500,000 into this policy over the next 10 years, that eats into most everything that you already have. Okay, I don't know how you continue to fund the policy. Well, that's because you don't understand how whole life works. Okay, you can use the cash value that's in the policy to fund the policy. You can take a reduced paid up. That is a contractually guaranteed right you have. What you're doing is you're telling the insurance company, I don't want to pay any more premiums in the policy. So please reduce my death benefit accordingly. And they'll reduce you'll see a one-time reduction in your death benefit, but no reduction in your cash value. And then your cash value and your death benefits start growing again because you're still getting paid interest and dividends. Okay. So your whole life insurance policy at no point will ever be a liability to you. The other thing is, in this particular policy, I think it was year 3 or year 4, every dollar you pay into the policy now results in more than $1 of cash value growth. So if you pay $50,000 into the policy, it's not like you just flush $50,000 down the drain like you're doing when you put it in the market. No, you put in $50,000, your cash value grows by $52,000 immediately with no market risk and no taxation. So if you need that full $50,000, no problem. Pay the $50,000 premium into the policy, immediately draw out $50,000 via a policy loan, and that full $52,000 of cash value is still earning for you in the policy, right? So by year 3, there should be no problem with funding this policy. Heck, take out a $50,000 loan, pull $50,000 from a line of credit, like if you had a reverse mortgage, put it in the policy. You can take out a policy loan and immediately pay that back, and you'll still net more in the policy. Okay. So whole life policies, we have to get away from doing what this financial advisor is doing. You cannot view the premium payment as a liability. That's not what it is. Okay. We are not draining assets to fund this policy. What we're doing is instead of running our cash flow through a checking account that gives us no benefits, we're running our cash flow through a specially designed whole life insurance policy where now we can use every dollar twice rather than once.
Absolutely.
I don't know how you're going to keep funding it. Yeah, that's because you don't understand anything about whole life insurance works, and the level of ignorance this guy is demonstrating in writing
Well,
is
and the other
just
thing too,
shocking. I
though,
mean,
is,
it's shocking. I guess I shouldn't be shocked, but this is
here's the
pretty
other
bad.
thing. You know, not to say it wouldn't be a bad idea to put a whole, like, you never said you were going to take all of his money in this example and put it into the policy, which might be a good idea, might not be, but it almost sounds like immediately he's like, yeah, if you do this, you're going to run out. That's what I heard. You're going to run out of money if you do this. Huh? I don't, where did you come up with that?
Yeah, because he's viewing it as a one-dimensional asset instead of a two-dimensional asset. And again, if the financial advisor had partnered with me, we would probably come up with a better solution because I want to work with him and understand the full picture. Like, you have this money in an investment account, Mr. Financial Advisor, can you please help me understand what was the strategy behind this? And then I can work with you and we can come up with a great strategy together, because this is not the final solution. This is something I came up with, which I think could work, but that's based on limited information, right? So he's treating it like it's the final solution when it's not. And of course, he's clearly demonstrating he doesn't understand how it works, what it's being used for.
And this brings up, I think, I don't even know if we touched on this yet. In this situation that you're talking about working with him, if he was life insurance licensed, frankly, you could have partnered with him and you could have split the case, right? So
Absolutely. Absolutely. And if he's contributing, he deserves some of that. No problem.
Yeah,
I have no problem.
absolutely. And
No
you,
problem.
I know you would have no problem with that. That's what professionals do, right?
Yeah, he would assist me with case design because to do proper case design, I would need to understand this money in the investment account. Why is it there and what's the strategy behind it? That'll help inform the case design, right? So I'm taking a big picture approach and I'm offering this financial advisor an opportunity to partner with me to add more value to his client. And instead, the financial advisor is just being like Gollum, just holding on, holding on to it within this vice grip, right? Where unfortunately, this client has basically been bullied. That's really what it boils down to. And now he's throwing good money after bad. Because it's just psychologically really difficult to admit, you know what, this was a black hole and it was a mistake.
Yep.
But it's not too late, right? Like I talked about before, between a reverse mortgage, an annuity, survivorship whole life policy, and maybe a long-term care plan, all of a sudden you got yourself in a much better position, right? Without taking on while de-risking, right?
Yep. And we're gonna wrap up here, Logan. But one thing I just want to mention, in case there's any other financial professionals out there, insurance agents that run into something similar to this, from my 21 years of experience, the one thing I am going to say is, if the client decides to stay with their advisor, whatever, please document in that case, put the date, document everything. But your chat, save your emails, okay? So if things do go bad, and for some reason the spouse tries to come back on you, even if you didn't do any work with it, please just document this. It's very important to say, look, I met with him. We made a recommendation, or we gave him some options to choose from. And here's what the financial advisor poo-pooed the whole thing. Okay. You're okay in that situation. Nobody can come back on you. But anymore with the way things are, it's always, I hate that I even have to mention this, but it's always CYA. You got to just, protect yourself. So anyways, Logan, thank you again for taking us through this. We're gonna do a part 7, right?
Yep, we got more.
Okay. All right, guys. Well, I hope you enjoyed that. Logan, thank you so much for doing this while you were traveling on the road. Safe travels, and everyone, God bless, Godspeed.
Thank you, Peter. God bless everyone.